Hello traders, Gary Wagner here, just about 10:30 in Honolulu, 3:30 in New York. It is Tuesday, but more importantly, it is the first day of December 2015, and this is the daily report for gold and silver. How quickly this year is coming to an end as we now enter the final month of 2015. We are now within the month when we will know if the Fed actually, after 9 years of flat interest rates, begins that rate hike and initiates, as they call it, liftoff. We do have gold trading higher on the day, up nominally, up about $4.25. 1068.85. That's off of a high of 74.71 and a low of 63.43. So we're right about in the middle of the ground. Now, in terms of the other precious metals themselves, silver is trading up about 8 cents at 14.15, the low 14.04. And the high 14.25. Interesting thing with silver is whether or not it can hold above $14. Obviously, if we see a continued rally, that will be the case. But let's take a look at gold, because we do have an interesting scenario building in gold. The key in terms of what we're looking at is the fact that we have absolutely made a new low when the market came down and tested these areas at 61. The prior low was this low right here at about 71, and the low behind that was this low here, and this low here comes in at 1145. And as we talked about a little bit yesterday, the pattern that we have been seeing is the market coming and making a new high, and then after it makes a new high, it trades within a defined range, and then from that defined range, it breaks to a new low. So we've had these series of lower lows, and even though the market has had the ability, for example, to come off of this low here, to come off of this last low here, and to come off of this last low here, the overwhelming characteristic is that on each occasion that it made a new low in the market, that low was followed by some sort of a rally that would really come in just prior to making another low, and in this case, another low, or a lower low, I should say. And that's why I haven't been extremely optimistic about this last set of higher days that we have seen. First of all, 2 days do not make a market, or a rally, I should say, but the fact that the market has eloquently held these grounds, that to me is substantial. But if we look at the straight, for example, candlestick pattern that we get within our daily charts here, we do truly have what's known as a piercing line. It's this 2-day pattern in which you have a long red candle, and then from the long red candle the following day, you're going to open at on a continuous market, such as what we call Forex or spot, and then close at or above the midpoint of the prior red candle. And so we definitely get that here. Here's our close, and we can say that that closed definitely at the midpoint of the prior candle. And then you get a green candle with a higher high and a higher low. That's our confirming candle here. However, the confirming candle doesn't have a whole lot of strength. It's well off of the highs that we've seen on the day, as you can see, trading about midpoint, and we haven't yet taken out on a closing basis the open of the red candle, which to me is significant, because that to me shows me real follow through if it can actually make it above that. And that's why we have not issued any kind of a buy signal. Of course, we had a conditional sell signal, but we didn't get any follow through selling, and that's why it was conditional. We've had these conditional signals in the market, and they've really been based upon, most importantly, what happens on the following day, because we have to see follow through to make them significant or meaningful. Now, in terms of what I'm looking at, as I talked about yesterday, we tend to have these lower lows made, then we come up with a lower high. In other words, we don't take out the most recent high. For example, this is at about 1230. Market comes down, it makes these lows here at 1071, makes a high, but that high is insignificant because it's well below this high. We then make a higher low, and that's what we talked about, that interim point. Then we take out the high, and then we make a lower low, and that's really been the pattern. We can look at that pattern throughout the last year, in which we will get a lower low, but but we don't get the higher high, so we go sideways in the market for a while and then come in and make the lower low. And that's why, for that reason, my sense is we still could see the market track up to some point. And as I said, the points that I'm looking at are at either 1103 on the high side or 1083, 1081 on the low side, that being this particular retracement level. And so based upon that, if we can really steamroll through this one area, which is 1080, then we might get a nice little rally in here, because of course 1080 to about 1100, 1090, that's $100 rally right there, and that would be significant. It would be something that we would definitely want to make a play on. But as I said, we've got to see that transpire, because now that this month has come to an end, if we look at, and we don't do this that often, but if we look at the monthly chart, let's go ahead and blow this up just a little bit, but you can see how the monthly chart has literally closed at that 61% retracement level. This is 1065, but the 61% retracement level is what we like to call a harmonics, because we also, just above it at 1084, we get another level. So we have these two different levels that are coming in the market that are really close together in terms of the big picture. On a monthly chart, you're talking about a $20 spread right here. So until we really get above 85 or below 65, I should say, both of those, we still could see this market find some support and bounce back up on the long-term charts. However, it's not something that I'm really looking at, nor is it something that I believe is going to be an immediate outcome. But we'll have to see how it unfolds. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.